In July of 2012, Mark Zuckerberg financed his $5.95 million Palo Alto home, which is 3 miles away from Facebook's headquarters, with a 30-year mortgage. At that time, he was 28 years old and the world's 40th wealthiest person, worth an estimated $15.6 billion. The question is, why would you get into debt when you have billions of dollars and can easily afford it? If he wanted, he could easily buy a dozen $6 million homes in cash without batting an eye. So why get a mortgage? The answer is long and complicated, but in short, it's free money. Sounds ridiculous? Who would give you free money when you are already a billionaire? Let me explain. It all has to do with interest rates. The inflation rate in the US is 2.5 to 3%, so any money you borrow below the inflation rate is considered free money. Zuckerberg's mortgage rate is just a little over 1.05%, but it is adjustable, meaning that based on circumstances, the rate could go up. If you do the math, the bank is the loser since the mortgage rate is below inflation. You don't have to be a genius to do the math. For the sake of example, let's say you borrow $1 million at a rate of 1%. The average rate of return on a savings account is 2.4%. Even if you deposit that $1 million in another bank, you end up making $24,000 a year while only having to make a monthly payment of $10,500 to the bank that lent you the money. Imagine doing that with $100 million or even $1 billion. When you can borrow for free, there's no point in tying up your own money when you can use it for more profitable things. Of course, when we are talking about small amounts of money, this might not make sense because the difference isn't that big. However, when it comes to large sums, playing around with 1, 2, or even 0.5% could potentially mean dozens of thousands of dollars, if not hundreds. Let's say you are a businessman and can easily afford a $1 million house. Why buy it when you can finance it for 1 or 2% while investing the rest of that money in your business that could potentially get you 10, 20, or even 30% returns? Even if you are too lazy to find a more profitable way to use the money, just throwing it all into an index fund can be much more profitable, especially over 20 or 30 years. Historically, an index fund has shown an average return of 8%. If you take a mortgage and invest your money in an index fund, the percentage difference will end up in your pocket. It all comes down to opportunity cost. Economically, it wouldn't make sense for Zuckerberg to buy the house in cash when he has been offered a 1% mortgage rate. But he is not the only one who is smart enough to do this. Take Elon Musk, for example. Most of his wealth is tied to Tesla and SpaceX. To buy a house for $20 million, he would probably need to sell a considerable chunk of his wealth, pay taxes, and incur other expenses. However, he can take free money and keep his monthly payment under his budget. He took out a $61 million mortgage for 5 properties in California with a monthly payment of $180,000. This isn't unique to billionaires, it's also practiced by moderately rich people like Jay-Z and Beyoncé. They took a mortgage to buy their $88 million house. They put down 40% and financed the remaining $52.8 million. That leaves the couple with a $149,600 monthly payment. In comparison, the national median home value is $200,700. Instead of tying up $53 million in a house, they know where to invest it to maximize profit. At the end of the day, they've made a lot of great investments, and they are on their way to becoming billionaires. The richer you get, the better ways you find to make more money. But let's be honest, not everyone gets such a low mortgage rate. Nationwide, it's around 3%, but even at that rate, it still doesn't make sense to purchase a house if you can finance it. Let's get this clear first. Why do the super rich get a lower rate than the rest of the country? First of all, when you are a billionaire, the bank can sleep calmly because no one is worried that you might default on your loan. If something does happen, you can easily sell part of your business to pay back the mortgage, taking the risk out of the equation. Compare that to an average employee who could get sick, lose their job, or face financial trouble. Secondly, paying your mortgage on time every month helps you build and maintain a healthy credit score. So when you're in trouble next time, a strong credit score will make it easier to borrow money from the banks. You are essentially building trust between yourself and financial institutions. But it could also work the other way around. Banks offer low mortgage rates to establish strong relationships with rich people so that when their companies need a loan, they come to them instead of a competitor. It's a win-win situation. These low mortgage rates are adjustable, which means, as mentioned earlier, they could go up. However, no one is worried because if it stops making economic sense, these ultra-rich people can easily pay back their mortgage. Most people associate debt with something negative because we usually borrow money we can't afford for entertainment and end up paying back a lot more. In fact, right after college, you realize what a burden student debt can be. Once you calculate how many years it will take to pay back, you immediately create the perception that debt is bad, especially when you can't default on it. Playing around with debt isn't easy. You are taking a huge risk, and a small miscalculation can lead to disastrous consequences. In fact, many people are so indebted that they can't even afford an unexpected $500 bill because of all the monthly payments. However, that's what distinguishes bad debt from good debt. Debt can ruin your life, make you homeless, and cripple your family if you are reckless, but it can also make you unbelievably rich if you know how to use it. Because it is leverage. Leverage is a superpower that can make you rich instantly. Let's say you buy a phone for $10,000, go to the market, and sell it for $11,000. Congratulations, you just made a $1,000 profit. But that's not much. Now, imagine using leverage. You go to the bank, borrow $990,000, add your $10,000, and now you have $1 million. You buy 100 phones for $1 million and sell them for $1,100,000. But you still owe the bank, so you go back and return the $990,000 you borrowed plus $10,000 in interest. Now you're left with $100,000. After deducting your initial $10,000, you have $90,000 in pure profit. That's how you make money when you don't have money. The bank made its share, and you made yours. Of course, when you take this formula to the extreme and it's not regulated by the government and practiced by everyone on Wall Street, it turns into a financial crisis, as happened in 2008. Remember when home prices crashed and took down the entire economy with them? Well, it's because investment banks used leverage to maximize their profits to the point where the strategy backfired. They started giving mortgages to people who didn't have good credit scores and weren't financially prepared to make the monthly payments. When they defaulted, it was a nightmare for investors because home prices, which had been rising for 40 years, suddenly dropped. We won't go into the details of the 2008 financial crisis, that's a story for another time. But it remains a major tool that rich people use to make money. It's risky, and you can lose everything, but if you know what you are doing, you can make a fortune overnight. I hope you enjoyed this video and, most importantly, found it helpful. If you did, make sure to give it a thumbs up. And if you want to see more videos like this, consider subscribing and clicking the bell beside it so the next video appears on your homepage and you won't miss it. Thanks for watching, and until next time.